sentiment in terms of professional managers. Their portfolio positioning is at some of the lowest levels that we've seen in recent history as well. So again, everybody's kind of on the I don't want exposure to the markets right now kind of boat. And that typically turns out to be decent buying opportunities. And I'm not saying you should jump in with both feet here and buy this, but again, the markets are so negative and so oversold here, as we've been talking about here for the last week or so, is that that's the type of environment that gives you a decent reflexive rally, and you should use that to sell into. The point that I'm trying to make here is not to panic sell these bottoms. And you look back and go, man, I wish I would have sold that, because now you get this kind of rally. And again, we kind of saw this yesterday. Markets kind of sold off yesterday morning. We saw some buying coming back in the afternoon. Again, there's not a lot of upside here, unfortunately. The 20 days crossing the 50-day moving average now, that's starting to put some downward pressure on prices. So a reflexive rally could be 100 points, 150 points or so, but I would use that rally to reduce risk into. Now, it's got a lot of earnings that are going on. Today after the bell, we've got AMD, and before the bell, we've got Marathon Petroleum. We've just got a long list of companies here as we're just kind of in the midst of earnings season, and companies are reporting those estimates, and that's helping give really kind of a mixed bag of performance. Some companies are reporting decent earnings and they're getting a little bit of a pop out of their earnings report, but the real kind of the real trend has been companies reporting okay earnings, but weak guidance. And that's really been pressuring a lot of these stocks lower. This is the punishment of stocks has been much greater than the reward in this current environment. We're not seeing stocks open up 15, 20%, but we're seeing stocks open down 10, 15, 20% after basically beating or meeting earnings estimates, but just offering some weak guidance about the economy, which we already know, right? I mean, we already know the economy's weak and is probably going to get weaker as the Fed tightens monetary policy, but that's exactly what the job is. Fed hikes rates to slow economic growth. That'll help quell the inflation problem. And, that's going to be the other side of this. So now, interesting, one of the supports that are coming in, we're seeing a lot of companies do this. BP, as an example, just boosted their stock buyback program. The window for stock buybacks just opened yesterday. And over the course of the next month and a half, this is one of those kind of a bullish tailwind for stocks, is that over the next month and a half, we're looking at probably about $4 to $5 billion a day being put into financial markets by corporations buying back stocks. Apple just boosted their stock buyback. ExxonMobil just increased their stock buyback plan. So a lot of these companies, in order to continue to meet estimates amidst an environment of weaker earnings growth, weaker revenue growth, are buying back shares. So that reduces that per share comparison, helps boost bottom line EPS so they can meet Wall Street estimates. But a lot of companies have a lot of cash right now. BP is a good example of this. Tons of cash sitting on their balance sheet, not much else to do with it, so they're using it to buy back stock. And again, as I said, that window opened up yesterday, so we'll see some support coming into stocks over the course of the next month and a half before we get to the next blackout period for the quarter 2 earnings reports. So over the next month and a half, we'll see some buying potentially for corporate shares as these stock buybacks get put into place. And right now, as an example also, we have the second highest level on record to date so far of share buyback announcements by companies. So there is a tremendous amount of share buybacks that are being planned for this year by companies. And yes, we can get into the not so good outcome of share buybacks, but for right now, that'll help lift asset prices over the last several years. Just to put this into some kind of comparison for you, over the last few years, stock buybacks have accounted for almost 100% of the net asset purchases. So between the buying and the selling that goes on within the markets, corporate share buybacks have accounted for almost 100% of the entire net purchases. So they have been a very, very influential piece of the market rise over the last few years. And again, when you're taking a look at kind of where markets are now and you're looking for kind of a bullish catalyst to give you a lift higher, stock buybacks may be that very one thing that helps give some support to the markets. Now, it doesn't necessarily mean that it's going to run markets up to all new highs, but it could limit some of the downside in the markets because of that support coming in from these very outsized levels of share buybacks. All right, when we come back from the break, we'll talk a little bit more about the Fed meeting tomorrow, what to expect, how the markets may react, what's going on with bonds. Got a lot of stuff to get into this morning. Get by the website. Our latest article is out on the website now, realinvestmentadvice.com. Don't go away. Be right back for the Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. Realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. I'm your host, Lance Roberts. You know, it's amazing what you can catch on a Ring camera. Y'all have a bunch of these in your neighborhood?
Oh, yeah.
Yeah.
I'm famous.
You're famous in your neighborhood?
Yeah.
Like you're on everybody's camera?
I'm on everybody's camera.
Why?
I just show up.
You're that creepy guy.
Well, you know.
So, yeah, yesterday, if you don't have a Ring camera, what it is it's a doorbell that you replace your doorbell with, and it has a camera on it, so you can see who comes up to your door and those type of things. And so we have one in our house, and so when somebody triggers it, and the way our house is, it not only catches the porch, it also catches part of the front yard and the street. So if somebody kind of gets into the front yard, it'll trigger it, and you'll get an alert on your phone. And so, yesterday, so a little bit of backstory here. Dragons are real. About a year ago, we had just gotten our pool finished, and my wife took my youngest daughter down to the pool store to buy a float. Now, she's thinking that she's just going to buy a little, kind of just a little flat float, one you just kind of sit in a pool with. No, my daughter finds this one that's as giant as you can imagine. It fills up about a third of the pool when it's in the pool. The pool's not that big. This thing's huge, and it's this float of a dragon, right? So it's got this big head on it, and it's got a tail coming out the back. And of course, it's the biggest float they have in the store. But that's what she wanted, and my wife's a pushover, so she bought it for her. It takes about 15 minutes with one of those, those electric air pumps to pump this thing up. This is how big this thing is. So over the weekend, it's finally sunny outside and temperatures have come back up. The water's warmed up. So my older daughter decides to go outside. She needs to work on her tan, because summer's coming up and prom and all this. So she needs to look good. So she's going to get a little bit of sun. So she goes out on Sunday and she pumps this dragon up and puts it in the pool. All fine and dandy. She spends the day out in the backyard, sunning herself with the dragon. Yesterday morning, we just got out of the studio, and my Ring doorbell goes off. And so I pull up my phone and I look at it, and here's my wife chasing the dragon down the street because the wind now picked up and it literally lifted this dragon out of the backyard, over the fence, into the front yard. My wife's chasing this thing down the street, trying to catch it. And she finally, she gets past the Ring doorbell, so it stops recording it. And a few minutes later, my doorbell rings again. And it's my wife literally trying to shove this thing through the front door of the house so she can get to work. Now, she's dressed for work. She's got heels on, the dress, the whole 9 yards. She's dressed for work, chasing this dragon. And here she is trying to shove this dragon through the front door of the house so she can get off to work. So I'm seriously thinking about putting my Ring doorbell on like TikTok or something.
You need to publish that clip.
Yeah. Not every day you see dragons in your neighborhood, but yesterday was the day. So anyway, stuff that happens around my house. It's never stopped. Anyway, a couple of things. So just talking about before the break here, yesterday markets kind of opened down a little bit yesterday, rallied back into positive territory, sold off yesterday. Actually got down to about 40.80 on the S&P yesterday, so very close to that kind of that 4,000 level. Then rallied all the way back to being up about 0.5% yesterday. Finished the day up about 23 points. Very strong rally from a tech standpoint. It was tech stocks pretty much driving the rally yesterday and some energy. And again, this is not what you would expect to see. What you would expect to kind of see is a rally in the markets that was maybe a growth trade or inflation trade or whatever, but you got both, right? You had the growth trade with the tech stocks and oil stocks did well yesterday. Staples, consumer healthcare, those didn't do very well yesterday. So it wasn't a broad rally, and that's one of the kind of the I guess concerning things with the markets right now is that you're not getting a very strong, broad rally across the board. This is very much pockets of rallies that you're getting, and they're not lasting. You get a rally one day, and this has been kind of the challenge, for portfolios, is that you get a rally one day in one area, then it sells off the next day, or you get a rally in the markets one day, then it sells off the next day, and we can't really string, a couple of days of rally together. We're not really going up. We're not really going down. We're just kind of this up, down, up, down, up, down. It's nauseating. It's a seasickening almost, because one day you feel good, next day it's terrible, right? Yesterday we're up, today we're down, and that makes it very challenging to manage a portfolio. Period. Right? Because nothing seems to work. Every time you buy something, it goes down. And then you sell something, then it turns right around and it goes up, and it's difficult. And this is just kind of where we are right now within the markets. Now, tomorrow, and right now what markets are trying to do, as I said, is everybody's just trying to position ahead of the Fed. Nobody's sure 100% what the Fed's going to say or do. That's the big challenge. What if the Fed says, full speed ahead, markets be damned, we're just going to raise rates to kill inflation, right? It's terrible for stocks at that point. So at that point, you certainly don't want to be in stocks. If they come out tomorrow and say, "Hey, look, we're hiking rates because we're concerned about inflation, 50 basis points, just like we've said. We're going to taper our balance sheet, just like we said. But we're watching inflation, right? And we think we may have seen a peak in inflation." I'm not saying they're going to say this. I'm laying out some examples, and my point is they say something that is a little bit more dovish, there's enough fuel in the markets for a fairly decent rally. I think we could see the markets rally, almost regardless of what the Fed says yesterday. Just having some certainty about where the Fed is positioned once we get that statement and hear some commentary by Jerome Powell. I think it's very possible the markets rally just because markets are so negatively biased at the moment. And I'm just saying the markets are so negative, it doesn't take much to get a little bit of positive news to push the markets higher. And that's all you need is just a little bit of positive something, right? You just had bad news after bad news after bad news, and it's just really crushing, investor sentiment and market psychology, and so you get any kind of, and what it's kind of like that stretching of the rubber band we've talked about so many times here on the show, is that negativity has gotten so stretched now that it only takes it doesn't even take good news, it just takes a lack of bad news to get you a reflexive rally, because markets have gone so far in terms of into negative territory. And again, that doesn't necessarily mean price or valuations. We're not talking about that. We're talking about sentiment. And sentiment's what drives stock prices. And it's hard to suggest at this point. It doesn't mean that it can't. And this is the important thing. There's nothing that's impossible with financial markets. But it's hard to imagine sentiment getting much weaker here, because again, from a technical basis, from a a sentiment basis, a lot of these levels that we're talking about at the moment are at levels that are normally kind of associated with at least short-term market bottoms. It doesn't mean that you can't have a further bear market, right? It's just not likely to happen without having a bit of a rally first to a lower high. Bear markets tend to be these kind of slow rolling events that you get over a long period of time. It takes, 8, 10, 12, 14 months. And part of that is this, kind of the ebb and flow. It's just this, markets come down, they rally back up, then you go to a lower low, then you rally a bit, you go to a lower low. And it just kind of ekes out over time. And unless you get some type of shock to the markets, such as a Lehman bankruptcy. We were in that kind of slow rolling bear market until Lehman filed for bankruptcy, and then the markets just broke at that point because you froze the credit markets. March of 2020, we shut down the economy. So you got a shock event to the markets, you got a very quick decline. Without some type of a shock event, you're likely going to have this slow rolling type bear market where markets just kind of grind themselves lower over a more extended period of time. And I'm not even saying that's going to happen. I'm just saying if you're in that bear market camp and you're saying, yes, we're in a bear market, we're definitely having a bear market, we're definitely going lower, it doesn't mean that it's going to crash all at one time. And you're going to get these kind of reflexive balances or rebounds to position into. You want to add short positions, great. You want to get out of stuff, great. You'll probably get a bounce from that. And all you need, again, is just a lack of bad news. And we just had a tremendous amount of it. War with Ukraine, what's going on, over there. Just kind of drilling headlines, resurgence of COVID cases in China. Just no matter kind of where you look, it's just been a lot of bad news. And earnings haven't been great. They're not terrible, but guidance hasn't been good. And so that's weighing on corporate prices as well. Like I said, today we've got quite a few earnings that are coming out. We've also got factory orders coming out. ISM declined yesterday. The Institute of Supply Manufacturing declined. That index declined yesterday. That decline in that index also suggests that we're going to have weaker economic growth going forward this year. Again, doesn't mean a recession, but it does mean weaker economic growth. Corporate sentiment, CFOs, CEOs, their outlooks are getting more negative. And we're hearing that in the earnings reports as well. And again, that's why we've seen even companies that are beating earnings, we're seeing their stock prices go down because, the outlook wasn't good. All right, quick break, come back, talk some more about markets, your money. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
How do the richest people of the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. Realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Good news out this morning. Dr. Anthony Fauci says the pandemic of COVID is now over. So can we please go back to living our normal lives?
Whatever normal was.
So there you go. Mission accomplished. Amazingly, just in time for the midterms.
Of course.
The Real Investment Show podcast. Same show, your schedule.
See, we need to be thanking Vladimir Putin for his invasion of Ukraine
At realinvestmentadvice.com.
because it solved the pandemic.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The most important insurance policy you'll ever own is the one you'll have when you die. Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income and protect your real estate. Thursday, May 12th at noon. Register now for the truth about life insurance at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning, 6:33, as we kind of get through this day. So, wrote an article, it's on the website this morning, talking a little bit about the issue of what we saw previously in the markets. And we talked about this on the radio show about a year and a half ago. And it was interesting at the time, because we talked about these young individuals that were making hundreds of thousands of dollars by doing videos on YouTube, et cetera, talking about investing. And there was, a couple of individuals that we discussed in particular that were making a lot of money from their advertising and their what they call, they're running ads on their channel, but they're also promoting products. So as they're doing their YouTube video, they're getting paid by their sponsors to do what's called affiliate marketing. and they're making tons of money. Now, it doesn't mean they were actually investing any money, but they were talking about, what was going on in the markets, what stocks they're buying. And, this was all during the Wall Street Reddit go-go days, right? Where you just bought stuff and it went up every day. And the riskier it was, the more money you made. And one of the sidelines of this was this attitude of how to be successful on YouTube. And there were 3 rules for social media. Be relatable, sell the dream, all bulls, no bears. Don't be bearish. And those were the 3 rules. As long as you complied with these 3 rules, pretty much you could launch a video channel and you could talk about, the markets and money and get paid for it. Not necessarily that you were making any money in the market, but you were making money by selling the dream, right? So you have to, show off your Lamborghini. And there was this one kid, he was 19 years old. He had just bought $1.5 million house in California somewhere. And, he's living at large, right? Of course, that has all now ended, unfortunately, as we talk about, ARK and a lot of these related go-to kind of go-go meme stocks. A lot of that fun and excitement has now ended, and Robinhood has now become the kind of the pariah of the younger generation. And when they figured out that free trading wasn't free and that their orders were being sold off to Citadel for what they call payment for order flow, and they got locked out of, being able to trade or sell some shares, the love affair between young retail traders and Robinhood faded fairly quickly. And so, this is kind of the point of the story today in our post on our website. And it's talking about this group of individuals that were all born. And again, the important thing, and we talked about this before, and we've written several articles on it. We wrote one called Retail Investors, get the majority of their financial advice from social media. Retail investors flooding the market, long on confidence, short on experience. And in these articles that we were writing during the time, and I put links in the article for you, so if you want to go back and see what we were writing back then, they're there for you. But the point that we were making is that in that market from 2020 to really 2021 was all driven by liquidity. But before that, going all the way back to 2009, we've had a decade of markets where stocks have really only just gone up for the most part. And every time you do have some type of corrective action in the markets, the Fed would jump in, start QE, or do some other form of bailout or whatever, and kept this bull market pushing ever higher. And it's interesting because most of the people that are writing these articles, and there's a whole rash of people that blog articles about the markets and money and stuff. And if you do a little bit of research, you'll find out that, these guys started investing. Their whole investment career started in 2010, 11, 12. And they're writing these articles about, just be a buy, hold investor. Markets always go up. But they've only had one real piece of experience. Yes, they can study history. And they can say, bear markets happen, but they always recover, right? If you look at history, bear markets always come back. So just buy and hold, put your money to work, etc. But they've never actually been through a bear market. And see, that's a very different thing. When you actually go through a bear market and lose half your money, the psychology of loss is very different. And this is the big challenge, right? Having experienced a bear market is very different than just studying what a bear market is, because again, you extract just looking at price history. If you've again, you can certainly tell that there's damage done to markets by looking at price history, but what you can't fathom is the psychological damage of what happens when markets go down 30, 40, 50%. And stay that way for years. Yes, markets always come back. At least they have so far. We can't say that they always come back absolutely for sure, but so far, bear markets have always come back and losses have always been made whole. It just took time to do that. 1929 to 1932 was an 80% bear market, and it took until 1954 to get all your money back. So again, it can be a very long period of time to get your money back, but it does come back over time. Just inflation, economic growth, etc., makes complete sense. The problem is that and again, this is one of the other problems with the buy and hold mentality, is that they look along these long periods of history and go, well, yeah, since 1900, this has always happened in the markets. Well, you don't live 120 years. You don't have that type of lifespan to invest. Your lifespan is between now and whenever you need your money for retirement. And yes, markets can go up or down. And you're going to have some variability just in markets over time. Just, markets don't always just go up. And there's this group of people that think that markets only go higher because that's all they've ever seen, right? Markets never go down. They do go down. But we've had a period of 12 years now where those drawdowns have been minimal compared to the upside. So we're going through one of those periods of repricing that is certainly not fun. And it's important not to let our emotional bias get the better of us. But we've also got to be careful of misinterpreting certain things, extrapolating trends, and allowing our psychological aspect control our investment positioning. One of the things that happens during a bull market is confirmation bias. And we've talked about these biases before, but this confirmation bias, we only search out information that confirms our thoughts that stocks are only going to go higher. During bear markets, we start running what's called loss aversion, which is another psychological trait where we start doing anything we can to avoid losses. These work together because when we're in the period of loss aversion, we start only reading stuff that confirms the idea that markets are going lower to justify why we're selling stuff and trying to avert more loss, right? So these psychological biases don't work independently. Unfortunately, they tend to kind of gang up on you altogether. And we flip from one side of the coin to the other psychologically, and we start making all these psychological mistakes that lead us to making poor decisions on outcomes. Now, again, if markets, and look, this market's been going down here this year, and it's everywhere. It's, there's pockets of strength that are there for a day or two, and then those reverse, and things that we thought were going to do well aren't, and things that we didn't think were going to do well are, and it's just been a very tough market to navigate this year. So when you have a market, and particularly like the month of April, where you had a just kind of a big drag on the overall market for the month, you're going to have some declination in your portfolio. There's no way around that. But variability in the short term is one thing, but we can make decisions that impair our long-term outcomes. And it's important to try to separate those two and have a strategy that says, okay, how do I get from point A to point B in one piece? That's really the goal. And so, the point of the article today is we kind of go through this analysis a bit and talking about, a lot of these stocks that everybody was chasing in 2020, 2021, those stocks are down 30, 40, 50, 60%. Even in the top largest capitalization stocks in the markets, those stocks are down markedly in some cases. Tesla, Facebook, etc. Those stocks are down sharply. There's opportunity being put together in some of these areas. The question is which stocks are going to recover when we come out of this period. And again, this is the important thing to remember. We're just in a period of the markets. This isn't the new market, right? This isn't going to be the market for the next 10 years. we're in a period of the market where things are challenging. But this is also where opportunity presents itself if we're strong enough to start doing that homework to find those opportunities and where they exist. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the truth about life insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. Realinvestmentadvice.com.
What worries you about your money? Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the Insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show. So it's 6:47 to get ready to kind of wrap things up this morning. Futures are down a little bit this morning. They've actually been recovering this morning. They were down more earlier. Earnings reports out this morning before the bell. Hilton Worldwide Holdings, Marathon Petroleum, Estee Lauder, Pfizer, KKR, Biogen, Paramount Global, Molson Coors Beverages, beer company, and S&P Global. After the bell day, we got Caesars Entertainment, Skyworks Solution, Revolve, Airbnb. That'll be kind of watched to see as a consumer measure, right? How are they doing? Are people still going out to rent houses to, for quick weekend vacation getaways, etc.? Starbucks, Paycom Software, Lyft, another kind of consumer discretionary. It'll be interesting to see, are people cutting back on ride sharing in the midst of higher prices. Match Group and Advanced Micro Devices, which will be kind of one of the bellwether stocks for the semiconductor sector. So again, kind of how AMD reports will be interesting. They're expected to report 92 cents on revenue of $530 billion, $5.3 billion in revenue. So we'll see how that but they're out. See, and for the semiconductor industry, what AMD says, not so much about earnings, but about their outlook will be very important. AMD and NVIDIA are two companies that are really kind of on the cutting edge of where we're headed, whether it's artificial intelligence, robotics, video gaming, Bitcoin mining. These companies are making the chips that fit into those kind of next-gen technologies. The question, of course, is going to be not only the demand for those products, but also their ability to provide those products because of shortages, et cetera. So one of the things that could weigh on the company is a negative outlook on being able to meet demand, right? So I've got demand, but I can't meet it because I can't produce enough chips. So again, how they report today will kind of set the tone for a lot of the other semiconductors they're going to report, as well as NVIDIA, which is one of the largest market cap stocks in the S&P 500. That's the bellwether that will move the whole index in terms of semiconductors when they report. But AMD will kind of give you a glimpse as to probably what NVIDIA is going to say. So we'll see how that comes out today. But again, that's kind of, we're right here in the midst of earnings season. This week and next week are going to be the two big weeks for S&P 500 companies. And interestingly enough, S&P earnings are still going up, estimates. So Wall Street is still increasing estimates for 2022 and 2023, despite the fact that these companies are saying, hey, earnings are okay, but outlook looks bad. Wall Street's going, okay, we'll lift estimates. We'll raise the bar for you to beat over the course of the next several months. And that's going to be more problematic for these companies. Now, what will happen, of course, is that and this is always the case, earnings estimates, can be wherever they are. They can be going up, staying flat, whatever they are. But as we start getting later into the quarter and we start getting more of the economic data coming in, what we'll get is this sell-off, or sorry, I shouldn't say a sell-off because it's not a sell-off. We'll start getting a reduction in those estimates. So what we're really looking for here is for analysts to start reversing those estimates. And that's where we'll start to see the estimates align with sentiment as well as outlooks, as well as economic growth, et cetera. And so that bar will come down as we start getting later into this year. But right now, estimates are very high. And the reason this is important is because when you hear about valuations in the markets, they go, well, valuations on the markets right now are at 17.5 times earnings. That's the lowest level since 2019. So we've had a big reversion in earnings for the S&P, but that's based on forward estimates. So the price of the market is down, but earnings estimates have been going up, which means that valuations, price times earnings, have been coming down. If we began to see a reversal of earnings and earnings began to come down in estimates, and let's say the price of the market is still flat, right? Then we're going to see valuations start to creep back up. That's going to be kind of the issue to be looking at. So again, it's just kind of keeping this in context of where we're headed. And estimates right now across the board are really very high. So those estimates have to come down just because you're already starting to see it in things like the Institute of Supply Management has come down, corporate sentiments come down. You see a lot of the economic data across the board is showing signs of weakness. We've got inventory builds. Now, inventory builds are deflationary because remember the whole economy and inflation itself works on a supply-demand basis. So as inventories rise, companies have plenty of stuff to sell. The problem is demand is falling. And so when you have too much inventory to sell, prices are going to come down to get it moved off the shelves. And this is going to take some time. And there was an interesting comment I got about this because I was talking about this very impact. Back in the day when we were growing up, companies used to stock a good bit of inventory because in order to get inventory from somewhere, say I manufactured something in China, I had to keep a good bit of inventory on my shelf because to get something produced and shipped to the U.S., it took a couple of weeks, right? And I had to throw it on the slow boat. The slow boat would come over, and 2 weeks later, I'd get my inventory, and I'd stock back up. And so I always had to have enough inventory in stock to maintain that ability to meet my customer demands. as we got more sophisticated, we started moving to what's called a just-in-time inventory method, and this was invented by the Japanese for efficiency. And basically, it got to where as long as I could get stuff so quickly because I could have it delivered overnight or 2 days or whatever, I could maintain less inventory and just have enough inventory on my shelf to meet current demand because I could replace it fairly quickly. So there wasn't a need to have a lot of capital outlay to maintain a bunch of inventory waiting to sell it. And so my comment the other day is that, as inventories are building up, in order for these companies to get it off their shelf and get it off their books, they're going to have to start discounting it, and that will bring down prices. And the comment I got back is that, well, companies have learned their lesson. They're going back to stocking inventories. No, they won't, because it's not profitable. Stocking and maintaining higher levels of inventory is a drag on earnings. And in an environment where companies are doing everything they can to meet earnings estimates amid slower revenue growth, the one thing they're not going to do is stock inventory any longer than they have to. So as this inventory builds right now and as demand slows, yes, they will start discounting inventory to get it off their shelves because they need to get the inventory moving so they can get new inventory in. And that's just the function of the way it works. Also remember too, another big aspect of all this is that we are now a society that is much more service driven. We used to be about 80% manufacturing and about 20% service back in the day. Now it's the opposite. We're about 80% service, 20% manufacturing. So the need to move product fairly quickly to meet service demand is important. So as these inventories build up and as demand weakens, there will be this move, which is deflationary, by the way, and this is going to help quell some of that inflationary pressure in the markets. We'll start to see that inflationary pressure come down, right? So that's it. Anyway, articles on the website this morning. Be sure and get by simplevisor.com. You check it out for free. I just posted every week now, we're now posting a new blog post talking about markets, sectors, just a quick technical rundown of kind of where we are, where markets are, to what, stops and entry points are, et cetera. But you can check that report out for free. It's on the website at simplevisor.com. Just subscribe for a 30-day free trial. Check out the reports, all the stuff that's there, and then see our portfolios, et cetera, and get some good ideas to help manage your money better. That's on the website, simplevisor.com. Outside of that, okay, tomorrow is Wednesday. We will, again, kind of be holding our breath. That'll be the FOMC meeting announcement. Then on Thursday, when Mike's here, we'll kind of go through all of we'll parse all the language, because that's going to be the real driver of kind of the markets between this meeting and the next meeting. What did they actually say? How did they say it? What does everybody think they mean? What does that mean for rates? What does that mean for equities? So we'll get into all that with Michael on Thursday, but this is going to be a fairly busy week between earnings, the FOMC, everything else we've got going on. Just stay tuned. We'll try to cover it as best we can, keep you up to date, and keep you on the right side of the trade as we go through here. The important thing, and I want to leave you with this, and this has been the conversation we've had all day, is watch your psychology. Look, markets are under pressure right now, but we are extremely oversold. I know I've been saying, kind of beating this drum for the last couple of weeks, but that's just where markets are. Super negative sentiment, very negative positioning. This is where investors make mistakes. If you want to get out of the market, I got it, right? Sucks. Market's terrible right now, but do it on a bounce. This is going to be one of those times where you'll get an opportunity to sell stuff at a little bit better price, reduce your exposure, raise a little bit of cash. We'll be doing the same thing. We'll keep you up to date. We post all of our trades on SimpleVisor. So if you go to simplevisor.com, keep up with all of our trades. We post all of our trading updates as we do them live. So they're all there for you. SimpleVisor.com, realinvestmentadvice.com. You'll find all of our articles and more. And if you have any questions, simply click the Ask a Question button. Always happy to help you out. Have a great day. We'll see you back here tomorrow. Stick around. 3 minutes on markets and money coming up on our YouTube channel in just a few minutes. Don't go away.
Always Sunday in the rich man's world.